John thought he had it figured out. Tomorrow morning, he is buying SpaceX. June 12, 2026. The ticker is SPCX. The price is set at $135 a share. The biggest IPO in market history. A $1.75 trillion valuation on day one. Bigger than Tesla. The 7th largest company in America before it has traded a single minute. John has $12,000 ready in his brokerage app. He has watched the countdown for 3 weeks straight. His group chat is on fire, everyone is buying, and here's the thing, John is not reckless. He is 40 years old, he saves, he reads. By every visible measure, he is doing this right. But John is about to make a $12,000 mistake that 64% of IPO buyers make every year. Not because SpaceX is a bad company, because John does not understand what he is buying at 135s. There is a number buried in the prospectus that changes everything. Most people will never read it. John did not, so before you tap that buy button tomorrow morning, watch this. We are going to run the numbers, the real ones, not the hype. Let us be clear about something first. This is not a SpaceX hit piece. SpaceX is an extraordinary company. Reusable rockets that land themselves upright on the pad. Starlink beaming internet to 10 million people worldwide. Starship reshaping the cost of reaching orbit. None of that is in question here. What is in question is the price. Because a great company and a great stock are two completely different things. You can love the company and still lose real money on the stock. The only difference between them is the number on the tag. That tag says $1.75 trillion. Here's what nobody in your group chat is telling you. SpaceX lost $494 billion in 2025. Then it lost another $4.28 billion in just the first quarter of 2026. The company's own filing admits it has a history of net losses. Those are their exact words. So how does a company losing nearly $5 billion a year get valued at $1.75 trillion? That is the question almost nobody out there is asking out loud right now. The answer involves a hidden mechanism, a rolling clock, and 30% of the shares set aside. Before you dismiss any of this as negativity, hear this. The math is going to surprise you. Let me introduce you to two people, John and Carla. Both are 40 years old. Both earn about $85,000 a year. Both have exactly $12,000 they want to invest. Both genuinely believe in SpaceX. This part matters, so pay very close attention. They agree completely on the company. They disagree completely on the plan. John is going to buy SPCX at the open on June 12th, no matter what. Whatever the price is the moment the market opens, John is all in. Carla is going to do something very different. She is going to wait. Not because she doubts SpaceX for one single second, because she has watched IPOs before. Carla knows the IPO price and the opening price are not the same thing at all. That $135 figure you keep hearing about? That is the price reserved for big institutions. Banks, hedge funds, pension funds, the insiders who got the invitation weeks ago. By the time the stock opens to regular people like John, it has already moved. On the average IPO, the stock pops 18% the very moment it opens for trading. So that $135 share actually opens closer to 159s. John will not pay $135. Almost no retail investor ever does. John pays whatever the crowd pushes the price to. And the crowd on day one is pure raw emotion and nothing else. Carla understands the second number too. The first day gains flow to the institutions. They bought in at $135. Not the people buying at 159s or 170. The pop is the reward for the insiders. Retail shows up after the reward is gone. Let us run John's actual numbers now. He has $12,000 sitting in his Robinhood account. At an opening price near $159, he gets roughly 75 shares. He feels great about it. The stock is climbing in the first hour. His group chat celebrates every single tick. For about a week, John genuinely looks like a genius. He screenshots all his gains. He feels smart and early and lucky. Carla, meanwhile, buys nothing on day one. She puts her $12,000 in a boring total market index fund instead. No rocket, no headlines, no group chat applause, just the whole market at a normal price. Two people, same company, same belief, the exact same $12,000 to invest. One of them paid the hype price. One of them quietly refused to. Now we wait and watch what actually happens to each pile of money. The gap that opens between John and Carla is the entire point of this video, and it is so much bigger than almost anyone watching this expects. Here's what nobody tells you about that famous $135 price. You will probably not get it. The $135 is the institutional price, negotiated quietly weeks in advance behind closed doors. SpaceX names the brokers right in its own filing: Schwab, Fidelity, Robinhood, SoFi, E-Trade. Those apps will let you buy SPCX tomorrow, but they will not sell it at $135. They sell it at whatever it opens at, and brand new stocks open with a pop. An instant jump driven by pure demand. The historical average first-day pop is about 18%. On a 135 IPO, that is roughly $24 a share, gone before you even tap the screen. So John, buying at the open, starts his investment at $159. He is down nothing yet. But he has already handed the insiders their entire reward. Run the numbers slowly here. John is up 0% and the institutions are already up 18%. Same stock, same day. Two completely different starting lines. That gap is not bad luck. That gap is the design. The system is built, so insiders buy low and retail buys the excitement. You just feel early. Here is a costly mistake that happens in the very first 60 seconds of trading. John opens his app right at 9:30. He sees that SPCX is finally live. He taps buy and hits market order. A market order means buy at any price right now. On a calm, stable stock, that is fine. On a brand new IPO, it is genuinely dangerous. The price can swing $10 between the moment you tap and the moment it fills. John could think he is paying $150 and actually pay $171 instead. The fix is simple, and almost nobody uses it. It is called a limit order. You set the maximum price you will accept. If the stock blows past it, you do not buy. Carla would never place a market order on day one. She knows the open is pure chaos. The spreads are wide. The prices gap up and down violently by the second. A market order on an IPO is handing the market a blank check with your name on it. If you ignore everything else today, remember this. Set your price. Never let the price set you. Here is the number almost no one actually bothered to read in the filing. At $135 a share, SpaceX is valued at a full $175 trillion. The company made $18.674 billion in revenue in all of 2025. Now divide one by the other. SpaceX is trading at 94 times its annual revenue, not 94 times its profit. There is no profit to speak of. It is 94 times every single dollar of sales. The average S&P 500 company trades around 3 times revenue. SpaceX is over 30 times that. On EBITDA, SpaceX trades at a stunning 266 times. These are not normal numbers at all. These are the numbers of a stock priced for absolute perfection in the year 2035. Every rocket lands, every Starlink dish sells, every moonshot pays off. That is the only world. Then there is Morningstar. They are not a meme account. They are a respected research firm. Morningstar ran the full valuation and put SpaceX's fair value at $780 billion. The IPO is asking for $175 trillion. You are paying 2.2 times the estimated worth. Read that again slowly. You are not buying a great company at a fair price. You are buying a great company at more than double its independently estimated value. It might be worth it someday, but you would be paying the someday price today. Let us make $1.75 trillion feel real, because the number is honestly too big to picture. It is larger than the entire yearly economy of most countries on Earth. It is more than the total value of Disney, Netflix, and McDonald's combined. To justify it, SpaceX needs to roughly triple from here and still look reasonable. Think hard about what that actually requires. Starlink dominating global internet for a decade. Starship flying cheaply and constantly like an airline. The AI unit beating funded rivals. All of it, at once, for years on end. That is not a forecast. It is a wish list. When you pay $1.75 trillion, you are pricing in a near-flawless decade in advance. Any stumble, any delay, any missed quarter, and the price has nowhere to go but down. Great expectations are the most expensive thing you can ever buy. They sit in every share. Here is what actually pays the bills inside SpaceX. It is not the rockets, it is Starlink. Starlink alone brought in $11.4 billion in 2025. That is 61% of total company revenue. And it is the only piece making real money, about $4.4 billion in operating profit. So when you buy SPCX, you are mostly buying an internet company that owns rockets. That is fine until you read the fine print. Starlink's revenue per user just fell 18%. It dropped all the way down to $81 a month. More subscribers, but each paying less. That is a warning sign, not a victory lap. Growth is slowing where it should accelerate. Now look at the other two pieces. The space and launch business lost $619 million last year. And the AI unit lost a staggering $2.5 billion all by itself in a single year. So one segment quietly prints cash, and two segments aggressively burn it every day. The $1.75 trillion price assumes all three eventually become massive winners together. History says that is a very expensive assumption. You are betting on three separate moonshots. Here is a real risk the hype completely ignores. Starlink is not alone up there anymore. Amazon is pouring billions of dollars into its own rival satellite network. Other nations and companies are racing into orbit too, year after year after year. That competition is exactly why Starlink's revenue per user already fell a painful 18%. When new competition shows up, prices come down. That is how every market on Earth works. The $175 trillion price assumes Starlink keeps its lead basically forever. But forever is an extremely long time in the fast-moving world of technology. Remember when nobody could compete with the iPod, or the BlackBerry, or MySpace? Dominance always feels permanent, right up until the very moment it suddenly is not. You are paying a monopoly price for a business about to have serious company. The moat looks wide today, but moats shrink the second the money pours in. Now let us be fair and steelman the other side for a moment. The people buying SpaceX tomorrow are not all fools chasing pure hype. Here is the strongest case the bulls would honestly make for it. Starlink is growing fast and already runs at a real operating profit. It crossed 5 million subscribers, then 10 million in barely a single year. Starship could crush the cost of putting almost anything into orbit. If that works, SpaceX effectively owns the highway to space itself. The AI unit is a wild card that could one day pay for everything. And great companies do sometimes grow into crazy valuations over a decade. Amazon looked absurdly overpriced for years, and the patient believers were right. So the bull case is not stupid at all. It is a real, honest bet. But notice what every single part of it has in common. It is all future. None of it justifies paying this price on day one, in the year 2026. Here is the clock ticking quietly underneath this entire IPO. It is called the lockup. And SpaceX designed a strange one. Normally, insiders cannot sell for 180 days after an IPO. That rule exists to protect brand new investors from an early flood of selling. SpaceX built a rolling schedule instead, one that opens the gates much, much earlier. Insiders can sell 20% of their shares just 2 days after the first earnings report. Another 10% unlocks early if the stock simply stays 30% above the IPO price. Then 7% tranches keep releasing all the way through the first 135 days. Another 28% unlocks right after the third quarter earnings results come out. The rest comes at the standard 180-day mark. Here is exactly why that matters to you. Every single unlock is a fresh wave of insiders suddenly allowed to sell their shares. And who do they sell those shares to? The retail investors who bought on pure emotion. People exactly like John. The early pop you are chasing lets them cash out very high. You provide the demand. They provide the supply. There is one telling exception here. Elon Musk himself locked his own shares for a full 366 days all the way out. The founder is staying put for an entire year. So ask yourself one simple question. Why is the selling timeline for everyone else so much faster than the founder's own? Here is something the splashy headlines tend to skip over almost entirely. When you buy SPCX, you get almost no real say in anything at all. SpaceX uses what is called a dual-class share structure under the hood. The shares sold to the public carry just one single vote each. The shares the founder keeps carry 10 votes each. The result is genuinely stark. He holds about 42% of the economic value, but controls roughly 85% of the votes. You can own thousands of dollars of this company and have effectively zero influence. You take on every bit of the risk of an owner. You get none of the control. That is not automatically a deal breaker on its own. Plenty of great companies run this way. Google does it. Meta does it. But you deserve to know the deal before you sign it. You are a passenger on the rocket, not a co-pilot. He alone decides the destination. He decides the speed. You just pay for the seat, and that seat is priced very high. Here is the part of this that is purely psychological. The hardest force to fight is FOMO. Your group chat will be screenshotting bright green numbers all morning long. A friend will brag that he is already up 12%. An influencer calls it generational wealth. Your own brain will quietly scream that you are being left behind forever. But that feeling is not information at all. That feeling is a trap. Most people end up buying at the exact moment of maximum excitement. And maximum excitement is almost always maximum price. Think about how this really works. The people posting gains all bought in before you ever did. They now need fresh new buyers to push the price even higher. Every euphoric post is, in effect, a tiny little advertisement for the stock. You are not seeing a tip from a friend. You are seeing someone's exit plan. The calmest investor in the room usually wins, almost never the loudest one. Carla is not smarter than John. She is just quieter. She turned off the noise. She decided in advance that no chart and no group chat could rush her decision. That single decision made before the open is worth more than any stock tip. Run the numbers on your own emotions first. Then run them on the actual company. Here is what the cold hard data says about IPOs like this one. It is not opinion. It is decades of careful records. 64% of IPOs underperform the S&P 500 in year one. That average 18% first-day pop fades to just 3% by month 12. The excitement slowly leaks out as the real numbers keep arriving quarter by quarter. It gets worse for the people who hold on for the entire ride. Buyers who held 3 years did 29% worse than a matched group of comparable stocks. And buying at the IPO price beats buying on day one by about 15%. Every one of those numbers points in the exact same clear direction. The earlier and more emotionally you buy, the worse you tend to do over time. We have seen this exact movie before too. Remember Facebook back in 2012. It went public at $38 a share to absolutely enormous, deafening hype. Within months, it had fallen roughly 50%, all the way down near $18 a share. It took over a full year just to climb back to its original IPO price. The company itself was incredible. The day one stock was a painful, expensive trap. John is buying at the open on emotion on day one of trading. He is standing exactly where the data says the losses begin. Carla is doing the boring thing the data quietly rewards over time. The market does not pay you for excitement. It pays you patiently for patience. Before you buy, picture the 5 ways this realistically goes wrong. 1. The pop fades and the stock sits flat for a year or more. 2. Earnings reports show the losses are simply not shrinking fast enough. 3. A lockup wave suddenly floods the market with cheap insider shares. 4. Amazon and rivals keep pushing Starlink's prices steadily lower. 5. A single rocket failure or delay spooks the entire market. None of these are far-fetched. Each one has happened to hyped IPOs before. You are not paid $1 extra for ignoring the obvious risks. Let us widen the lens beyond just John for a moment. Meet Maya. She is 28, earns $52,000 a year, and has exactly $3,000 saved. She sees the SpaceX hype everywhere she looks and desperately wants in too. For Maya, that $3,000 is many long months of careful, patient saving. It is real money that she genuinely cannot afford to lose right now. If she chases the open and the stock fades, she tied up savings in a coin flip. Maya does not need a moonshot in her life. She needs a foundation under her feet. The same exact trap hits so much harder the less money you actually have. John can survive a flat year on his $12,000. Maya feels every dollar of a bad bet. This is the quiet cruelty of financial hype on social media these days. It targets the very people who can least afford to learn the lesson. The right move for Maya is the boring one. Build the base first. Buy the broad index fund. Let the rocket prove itself on somebody else's money. There is no shame at all in waiting. There is only math. Before you buy anything at all tomorrow, ask yourself 3 simple questions. Question 1. Am I buying the company here, or am I buying the price? Question 2. What exactly has to go right to justify this enormous number? Question 3. Who is selling these shares to me and why right now? If you cannot answer all 3 of those calmly, you are not really investing. You are gambling on a feeling and quietly calling it research. John never once asked himself any of those 3 questions. Carla quietly asked all 3 before breakfast. That is the entire difference. It is not about intelligence at all. It is about which questions you sit with first. The best investors are almost never the boldest ones in the room. They are the ones who slow down exactly when everyone else speeds up. Maybe you have read all of this and you still want to own SpaceX. That is completely fine. It is your money and your call to make. So here is how a careful person would actually go about it. First, never use a market order on day one. Always use a limit order. Decide your absolute maximum price in advance and refuse to chase past it. Second, only use money you can truly afford to lose entirely. This is a single speculative bet, not your retirement foundation. Third, consider simply waiting for the first or second earnings report. Let the early lockup waves pass and let the price find reality. Fourth, size it small. A few % of your portfolio, not half of it. The goal is to survive being wrong, not to bet the entire house. Conviction is fine. Just never confuse conviction with a fair entry price. So let us run John and Carla forward 1 full year and actually see what happens. John bought 75 shares near $150, about $12,000 total invested. For a few glorious weeks, he is up and feeling absolutely brilliant. Then the first earnings report lands with a thud. The losses are still enormous. And right on cue, the very first lockup wave quietly opens up. Insiders quietly start selling their shares into John's wide-eyed enthusiasm. The stock slowly drifts back down toward that grim 3% reality. If SPCX follows the historical path, John's $12,000 is worth the same or less. Maybe $11,000, maybe a flat $12,000. The thrill is gone and the money went nowhere. Carla's index fund, meanwhile, just earns the market's normal return. Call it 8%. Her $12,000 quietly grows to about $12,160. The gap is not dramatic on day one, but it compounds quietly, year after year, in the background of her life. And here is the part that really stings for John. Carla can still buy SpaceX. After the hype fades, after one or two real earnings reports, after the price meets reality, she gave up nothing except the thrill of day one. John paid full price for it. One of them bought a story. The other one simply waited for a fair price. Now here is the part that completely changes how you see this entire IPO. Remember that 30% retail allocation everyone keeps praising? 3 times the normal amount. Everyone called it generous. Everyone called it the little guy finally getting in. It is not generosity at all. It is the strategy, plain and simple. A normal IPO sets aside just 5% to 10% for regular investors. SpaceX set aside 30%. So ask the one obvious question nobody is asking. Why hand so much to retail? Because retail demand is exactly what creates that powerful day one pop. Your own buying is the fuel for the entire fire on day one. The pop is the thing that validates that whole $1 trillion price tag. And that high price is exactly what insiders sell into when the lockup opens. Connect the two halves and the whole picture snaps suddenly into focus. You were not invited to the IPO, you were invited to be the exit. The 30% is not a gift handed down to you from above. It is the floor they need you to stand on while they walk out the door. That is the mechanism hiding in plain sight, in broad open daylight. Once you actually see it, you genuinely cannot unsee it ever again. And it leads directly to the one line worth remembering from all of this. A great company is not the same thing as a great stock. The price you pay decides which one of the two you actually own. So what should John actually do tomorrow morning? Not never buy SpaceX. That is not the lesson here at all. The lesson is simpler and far more useful. Separate the company from the stock. Separate the rocket from the price. SpaceX may genuinely change the entire world. Starlink may one day connect the whole planet. Starship may even make Mars real within our own lifetime someday. And the stock can still be a terrible buy at $175 trillion on day one. Both of those things can be completely true at the very same time. The most important financial decision you can ever make is this one. Knowing the difference between a strategy right for you and one right for the seller. Do the math, not the feelings. Wait for the price to finally meet reality. Make the decision that matches your reality, not someone else's launch day hype. Because here is the one truth the countdown clock will never tell you. Don't buy the hype. Buy the math. The math does not care how much you love the rocket.